Well, hello and welcome, and good morning if you're on Mountain or Pacific time, and good afternoon Central and Eastern. We have a lot of folks joining us today, and I'm really pleased to have you join us for this event. I'm Matt Lyons, a partner with Wilson Sonsini in Austin, Texas. And the webinar today is choosing the right type of growth capital for your tech startup. We have a terrific panel today, and I'm super excited about it. I joined Wilson Sonsini in April of this year, April 1st, but I've been practicing in the tech scene, including with some of these participants for the last 25 years. I've seen a lot of come and go. I never thought that things could be busier than they are today, but they keep getting busier and more intriguing. But the participants that we have who are serving this market that'll be speaking today and a lot of the others are fantastic. This is a great topic. When I started practicing in 1996 here, we would do, things were, a much simpler time. You would do a round of venture financing, maybe a bridge. Later on, Silicon Valley Bank would come in and do a financing. You may get some more venture financing, and you would either do an IPO or get sold. Now the range of alternatives from the different types of venture firms, the different stages of firms, the different debt options, venture debt options, other financing options, non-dilutive financing, and then the exit events, of course, have multiplied. IPOs, direct listings, SPACs, you name it, all the things that we're living in. So we're going to focus on somewhat the earlier stage today. So a few housekeeping notes. Today's panel, we're going to go round robin among the panel and let everybody tell us about their particular how they benefit and approach the tech and early stage market. We'll have a number of polling questions that we'll put out there of interest to you and hopefully to us, and to help spur some additional conversation and maybe some extemporaneous conversation. We know there are a number of participants on the phone who are founders and executives at startups. The ones that are geared toward the types of funding and so forth, we'd ask that those of you who are at the actual startups or would we be the ones responding rather than some of the service providers, so we can get a cleaner poll result, and we appreciate that. Throughout the event, we'll also have the availability for you to engage in some Q&A. We'll collect those questions as we go along. You can use the Q&A button at the bottom of the screen, input those, and the moderators behind the scenes will help filter some of those questions out for me and for the panelists. We ask no anonymous questions, so we can see where they're coming from and respond to you. If we don't address your question, it's probably because we addressed it or attempted to address it during the organic portion of the dialogue with our panelists. So without further ado, I will begin to introduce our panelists. They need no introduction, but I'll let them introduce themselves, and we'll start, I guess, as they appear on my screen. So Robert, do you want to start, and then the rest of you can introduce yourself and your firms?
Sure. Thanks, Matt. And thank you, Charlie, and the S3 team for including me. I look forward to today. So I'm Robert Srek with SVB. We're a full service commercial bank focused on working with technology, healthcare, and venture and private equity firms primarily. We have offices across the US, Europe, India, China, Israel, and Canada. Our client base ranges from early stage startups to post-IPO billion-dollar plus companies. Products and services we provide are full service, traditional commercial banking, venture debt, private banking, and investment banking. My personal role is I manage a number of our regional markets across the central and southeast, so ranging from Phoenix, Arizona, on up to DC and down through Atlanta and Miami. Thank you.
Matt, am I next on your screen?
Sure. Go ahead, Charlie.
I can't tell which way is on the screen, but yeah, my name is Charlie Plochet. I'm a partner with S3 Ventures here in Austin, Texas. We are a traditional early stage venture capital firm investing at seed, Series A, and Series B stages. Kind of round sizes from $1 million to 15 million or more, where we typically lead or co-lead with a check of a few $100,000 to 8 or 10 million, an initial check. We are primarily focused on the Texas market, although we do look outside of Texas. We are primarily focused on the Texas market. We're currently investing out of our sixth fund, which is about 200 million in size. Our total AUM is north of 600, which I believe makes us the largest venture firm in Texas that's focused on early stage Texas stuff. I've been with the firm for over a decade. We've got a team of 8 investment professionals that are all here in Austin, and appreciate you all making the time to chat with us today.
Great. Let's go on. We go another debt provider. Vic, how about you jump in?
Yeah, thanks, Matt, and thanks to the S3 team for including me in this this webinar. Vic Thopper, Managing Director with Dallas-based Cypress Growth Capital. We're a team of 6, all based here in Dallas. We all come out of the B2B SaaS more from an operator standpoint. So we think like an entrepreneur. So that way we can help and advise the companies we invest in. We're sort of a unique model in that we're investing non-dilutive capital. So we invest about 1 to 5 million into companies to help them scale to the next level, and then decide if they want to do an equity round at that time or an exit, et cetera. So we're oftentimes a bridge. We've just recently raised our 4th fund. We've made close to 40 plus investments, and we have a number in diligence as we speak. So looking forward to explaining more in detail.
Great. Chris, I guess it's you. You and I I've been at 4 different places since I've been in Austin. You've been at 3, so I got you beat by 1 these days. But why don't you give us some more on elsewhere and what you're doing these days?
Thank you to S3 for organizing this and including us. My name is Chris Bassetti. I'm a founder and partner of Elsewhere Partners, which I started in kind of late 2015. I've been investing for more than 25 years, making me feel pretty old. But I started at an East Coast firm called TL Ventures and opened an office here in Austin in 1998, and then joined Austin Ventures as a partner in 1999. And I've done a long tour of duty at Austin Ventures, and the benefit I got at Austin Ventures was working as a venture capitalist, and then evolving to growth equity and private equity, which has been highly influential on the strategy at Elsewhere Partners. So as the name would imply, we look elsewhere, which means we don't look in Silicon Valley or Boston or New York. We look in emerging regions. Obviously, learned a lot about the emerging region in Austin and have targeted other emerging regions, but we focus purely on expansion stage software. So we're a growth equity firm, and part of the impetus for this call is to explain all the nuances between venture, growth equity, private equity, which we'll do in a subsequent sort of slides. But we focus purely on software companies. Our sweet spot is 3 to 6 million in ARR, and we can describe that. Our check size has ranged from 5 to 30 million, and it all depends on obviously the scale of the company. And we're open to a mix of primary and secondary, which we can talk about as well. But primary is balance sheet, and secondary is liquidity for existing shareholders. So.
Great, thanks. Charlie, with S3 having put all this together, I guess I'm going to go ahead and start with you and delve a little bit more into S3, and tell us which of the companies that are out listening to us, I guess. And you see the first poll question is up. Thanks, Eric, for that, and we'll ask more as we go. So hosts and panelists won't vote, but question number 1 is up, so please vote for that. Charlie, do you want to delve a little bit more into S3, including where what companies are squarely in your target zone, and some industries, and kind of where's your sweet spot, and what are you looking at as you go forward? Are you looking at any new opportunities?
Yeah, thanks, Matt. So what we're primarily targeting is B2B software companies, and we are not industry specific. As you'll find with most Texas-based firms, there is an investment thesis around Texas as a region that's a great region to invest in, and not necessarily just fintech or just healthcare IT. So primarily what we're doing is some type of enterprise software that's solving a complex business problem and selling into a large enterprise. We do have a small part of our firm that also invests in traditional medical device companies, but that's a lot less than kind of the traditional B2B software. So no real industry focus, but when you peel back the onion of those B2B software companies, the skeleton really looks the same as far as how the companies are constructed, with an enterprise sales force that's selling enterprise sales cycles, with an enterprise customer success organization, with go-to-market strategies, different things like that. So even though a lot of times they're in different industries, they do tend to run into a lot of the same problems, and frankly, a lot of the talent is transferable. We're constantly pulling one person we'd worked with in a previous company and helping them get hired by a new portfolio company or after an exit or things like that. So that's primarily our focus, on the size of companies. Like I mentioned in the intro, we could start as early as really kind of seed, pre-seed with a few $100,000 check, where maybe we're investing in a safe or a note, or maybe that's priced around. But kind of our wheelhouse is more kind of a $3 to $6 million check, and call it a $5 to $10 million round. We're usually leading or co-leading that round, and that's kind of where the majority of our investments have been. And we've made 42, 43 investments over the history of the firm. And then in some cases, we do flex up and do 8 or 10 million in a $15+ million round, which I might call a Texas Series B. A lot of those Series Bs on the coast have gone crazy, and they're 50 and 100, 200 million. We're not leading those type of rounds, but anything kind of that 15 to 20 range, we could flex up and lead those type of rounds.
That's great, and that's relatively new, kind of flexing up into those. I like the term Texas Series B. I'll use that. So I'll credit you where I can, but I'm going to use that.
Yeah, I don't know that I came up with it. I got it from somebody, but it's the Series A, B, C nomenclature is getting mixed, and it just depends on who you're talking to as to how they interpret that. So I think it's almost better to talk about round sizes and kind of stage a company. And speaking of stage a company, there's that $3 to $6 million check is usually a company of 1 million ARR or more. Vast majority of businesses are a recurring ARR SaaS type business model. And those later stage investments are several million or more in revenue, where the earlier stages might be just a few customers with a little bit of revenue.
Great.
But we are typically investing post revenue when you have some customers using the product.
Yeah. Chris, I want to go to you and continue to talk a little bit about equity. So talk about the pivot from, you mentioned the inflection point at AV, right? From doing traditional venture to, growth into a little bit of private equity, into what you're doing with elsewhere. How have you talk about that niche in the market that you sort of carved out for yourself there, and what led you there, and which of the companies that kind of what's a good profile of a company that should be thinking about elsewhere?
Yeah, so being able to invest across that wide range of profiles, we saw different kinds of outcomes, and that helped us. Sorry, this poll popping up kind of annoys me, but I'm trying to focus and it keeps getting in my face. So we saw an evolution of various ecosystems. So the thing that we saw in the software sector was an increase in capital efficiency, which was mainly beneficial in these sort of elsewhere emerging regions. And so thanks to open source and outsourcing and shift to the cloud, we're actually seeing more and more companies get to 3 to 5 million in recurring revenue with just angel money, or even bootstrapped. But I would call them healthy but suboptimized. So they weren't growing or on a trajectory that would meet sort of an expansion stage VC lens, right? So something we should talk about is everybody has a risk reward lens. So if you come in at pre-revenue, as Charlie and Eric are willing to do, your risk is high, and so you look for a higher reward. When we're able to find these companies that are 3 to 6 million or so in ARR, with little outside capital, to us that's a lower risk profile for a couple of reasons. A clear product market fit. So we've seen plenty of companies that have raised 30 million to get to 4 million in ARR. That doesn't necessarily show a product market fit. And then there's a big preference stack. So in the downside scenario, your recovery of your capital is a little more challenging. So we saw an opportunity for, a high level of alignment with these entrepreneurs in these lower risk situations where, they have more balanced growth. So I would describe that as, 40, 50%. But what we've seen also is an evolution of the private equity ecosystem. So, I'd say the most annoying part of my first 15 or 20 years of being a VC was being tortured by strategics and getting left at the altar by Cisco or IBM or HP, 6, 7, 8 times, I don't know. And then seeing private equity, thanks to Vista, Tomo Bravo, Insight, and a bunch of other firms, emerge as this, very reliable, prolific buyer. And so we realized if we could help scale these companies from 3 to 6 million and get them to 20 million, there's at least 20, if not 30 or 40, private equity buyers out there. And the thing we learned to love about private equity is you hit a button and you get 20 bids in 48 hours. So they're always buying, and it's also partial liquidity. So you can, as opposed to selling the whole company to a strategic, you can just take part of your chips off the table and get a second bite at the apple. The other benefit to private equity is within every 4 years, they, are trading. And so you get a second bite of the apple in a very reliable way. So we just came up with a strategy of helping to optimize these companies that have been capital efficient to become, as a base case, private equity platform companies as they get to 20 million, and then bringing in, Vista and Thoma Bravo for that next phase of growth. So we just thought that was a kind of a void in the market at this sector. The companies that are 3 to 6 million in ARR for private equity, that's a bolt-on. So that's subscale at that time, and bolt-ons are very different, lower multiple, and you get merged into an existing private equity platform. If you can get them to 20 million, they can treat you like a platform, which is just, very different multiple and very different, long-term outcome. So, growth equity lens is, still, an investor in equity, but, our underwritten base case is 4x in 4 years, and we look for, kind of 50% growth that gets you to that 20 million. And that's just meant to be an aligned base case where we can transact with private equity at that, key growth milestone. Or, maybe it turns out better than that and there is a strategic, but the thing I love about our new strategy is I tell strategics to pound sand every 6 months because I don't need them. So they come in knocking on the door and we can say, go away, because, why sell the whole company when you can just take, one bite off the table and transact with private equity and do it again. And we have multiple examples of multi-billion-dollar companies, SailPoint, SolarWinds, Idera, that all went through private equity recaps, turned into multi-billion-dollar public companies or multi-billion-dollar private companies. So it doesn't limit the upside of the company. It's just a more pragmatic path that needs to be optimized, and that's why we decided to focus on that.
Right. Well, my clients feel the pain on the strategics these days, and there's some there's reasons for it, right? You've got a person running a P&L and has bonuses tied to certain things, or it's a much different objective, and they're trying to meet some quarterly goals and so forth. Whereas the PE has elsewhere. There's good pros and cons of each. So I'll come back to you on that. I want to switch over on the debt side. So we've got a lot of early stage entrepreneurs on here, so that's good. I mean, the entrepreneurial activity has been really unbelievable. As busy as we've been anecdotally, so 51% of our people are between 0 and 1. Between as busy as we've been on the de-SPAC side, the public offering side, and the financing side in general, just in our practice in this office here and firm-wide, we have been on a tear of new companies forming and so forth. So a lot of you are here, and good to see you. We'll talk a little bit about, as companies get into a little bit later stage, I want to talk to Robert about utilizing debt. So, you've worked with everybody on this panel at one form or another. So maybe talk a little bit about some of the products that Silicon Valley Bank offer. Silicon Valley Bank has been a stalwart in this industry since well before I ever showed up on the scene, and remains that way. And we've seen a lot of other banks that, dabble in the markets, or big banks that set up a technology and life sciences, and then it falls out of fashion with them internally for whatever reason. But maybe talk about Silicon Valley Bank and how you approach the market and how you've been so consistent for, well over 30 years, I guess.
Yeah, so thanks. And I've had the good fortune of doing multiple deals with everyone on this panel, and knock on wood, the outcomes have been great. So great experience. So the bank itself, we can provide lots of different services, but I'll focus on debt and helping companies as they grow. So we really look for a couple of things. One is scale. And has the company scaled to a point that risk is managed? And remember, we're a bank, we're regulated, and if we're wrong 2% of the time, we're out of business. So we underwrite to can we get repaid? And so while we do many bridge loans, we don't want them to turn into a peer. So we look at, has the company scaled? Could they raise equity if they desired to raise equity? Do they have existing investors that we have a relationship with? And in many circumstances, we're putting forth debt to pre-revenue companies if they've raised venture capital from firms that we know, have a relationship with, partners that we know and have a relationship with. So it depends on if they've raised equity And then as they scale and become a mid-stage or later stage business, then we're looking, quite often we're competing against equity. It just depends on what's the right capital structure for the company's business.
And so how do you compete against equity then? Do you do a blend with what's so-called venture debt? And what is that? And does that bleed over into what Vic and his team are doing, or?
Yeah, we oddly, in this environment, given the amount of capital that's in the system, we lose more often to a company raising equity than we do another debt competitor. And kind of stinks, but it's fine. It's the way it works. And so, it just depends on the size of the business. I would say at the early stages, it should be complementary. The reality is call it a Series A or a Series B, we're going to look to be a complement, say a third to 50% of the round in debt to the size of the venture round. And if you think about the benefit of that is it's a mostly non-dilutive capital source that helps a company extend the runway, maybe meet more milestones to help with the valuation on the next round.
Well,
and it's the debt with warrant model.
Why are those companies choosing equity over debt? The conventional wisdom, I mean, within reason, of course, the conventional wisdom is that the debt is less dilutive to the founders, to the existing equity sources. So why would you be losing out to that?
Yeah, what we've been seeing quite a bit lately is preemptive term sheets, maybe from insiders, maybe from new investors, evaluations that are semi-non-dilutive, and so they're taking the equity. What generally happens then is they'll take the equity and then they'll look to put debt in place at a later stage. So that's generally what will happen. Oops, sorry.
Great. And with the next poll question, that'll be great segue for us to talk to Vic. So Vic, talk to us in a little more detail about your brand of financing and the sort of debt that you provide.
Yeah, happy to do so. Just a little bit on the types of companies we invest in. Very similar to Charlie. These are all B2B SaaS, tech-enabled services businesses. They're not startups. They've got motion, and they've sort of hit this inflection point, and so they're heading in the right direction. And then similar to Chris and elsewhere, we're not investing in California, New York, Massachusetts. We're investing in underserved markets. And these companies tend to be in the 2 to 3 million in revenue to about 10, 12 million in revenue. So they're not startup, but they're not by any means, middle market or anything near that. So they're sort of in this, tweener phase is what we sort of call it. They tend to be bootstrapped, growing well, and now they're looking for some capital to take them to the next level. They're not really sponsored, so they haven't really raised a large capital round. So they really haven't had the benefit of putting a good amount of capital into sales and marketing. And so they'd like to get some capital to predominantly put towards that or an acquisition, sort of scale themselves to the next level. And then at that point, decide if they want to raise some capital from maybe S3 or get acquired by elsewhere, et cetera. So we're sort of that bridge to an equity round. So we technically are an alternative to equity, but we rarely compete with equity because the entrepreneurs we're investing in are not really looking for equity at this point in time. Even though we are technically a debt structure, the companies we're investing in are not really thinking of us as debt, even though it technically is. We've sort of captured the benefits of equity, which are expertise, help, capital on the balance sheet to grow with no covenants or personal guarantees, and the benefits of debt, which are non-dilutive, et cetera. And we sort of put them together to help, companies get to the next level.
What are some of the payment terms? I mean, they're going to vary, of course, but payment terms, what could a company expect in terms of the return that you're looking to return to your investors?
Yeah, so we'll invest.
Yeah,
so we'll invest 1 to 5 million. We have the ability to tranche it out where they take what they need when they need it, all the way up to 5 million. But once we make an investment, they're typically paying us somewhere in the 2 to 4% of monthly revenue each month. So as revenue goes up, revenue goes down. the payments flex up, flex down until a cap is hit, somewhere typically in the 1.5 to 2x range. So in the minds of our entrepreneurs, it's cheaper than a dilutive round today. Robert can, in some cases solve a company's working capital needs with us, and then we'll come in and solve their growth capital needs. So we're very, senior lender, collaborative.
Right. Charlie, let me throw it back to you and ask a question in terms of the interaction with debt. So as you're advising companies, let's say that maybe they don't have a debt, stack initially, you come in with a Series A or maybe a Texas Series B, but usually they've got some debt by then. When do you start, and each company's going to be different, how do you walk them through that process of considering when to bring on SVB, when to look at other alternative sources, venture debt, et cetera, and how does that grow? How does that conversation develop over the company's life cycle? We're focusing a little bit on the earlier stage, but talk us through that. And I've been in board meetings where we've talked through that with you before, so.
Yeah, and there's different types of debt that you can get from the Roberts of the world, right? You can have a line of credit that's sitting there that you can use if you need it, or maybe something that's tied to your AR balance. You can also have a term debt that's amortizing, where you have large principal payments each month. And what SVB and other banks will often do is put something in place that's interest only for a year, 2, 3 years, whatever the term is, and then it amortizes. And so, Matt, as you know, it's very company specific. I have seen companies that took on too much debt too early, and it ended up basically killing the company. We weren't able to kind of get it out when they hit an issue, and we could I think we're going to talk about maybe some lessons later. But in other cases, it can work out really well and kind of maybe help you bridge that to the next financing. And so it's something that, and these are discussions we do in board meetings all the time, but it's something that needs to be kind of carefully thought out. How much risk is the company taking? How predictable is their revenue? What risks are kind of going forward? Because once you do layer any type of debt onto the company, especially one that's going to be amortizing, have those large principal payments, it's just narrowing your window of execution, right? You just have to execute that. It just gives you, less room for error, I guess, as the company is growing and executing it. So very company specific, but I would say, SVB, the traditional banks tend to kind of go side by side with the VCs on kind of really high growth businesses. If a company, it's not necessarily high growth anymore, maybe they're growing 10 to 20% for whatever reason, not 50 to 100 or 200%. And maybe the equity markets are not what they're looking for. Then kind of that venture debt, which is kind of a different bucket of debt that tends to be large, that might be bridging to profitability, or hey, in 12 months, we're going to be cash flow positive or something like that. And then we think there will be an acquisition, or we're going to go to market and try to sell the company at some point in the next 12 to 18 months. Those kind of things, that's kind of a different scenario than maybe Robert's, the debt that Robert puts on companies. But it is pretty company specific, and I don't take lightly because I have seen a couple of things get burned on. And so in the end, we do kind of back whatever the management team wants to do, but we caution them, heavily, like, hey, be careful here. You need to be very thoughtful about how much debt you put on these businesses at different stages, and just kind of work with them through that process.
Robert, walk us through one of those
Matt,
scenarios.
hey, Matt, can I interject just a second?
That's great.
Charlie hit on something that is, I think, really important, is debt should be viewed as complementary at the early to mid stages and not in lieu of. And I think that's really important. And the situations where we've seen companies take on too much debt, it's when the amortization of that debt is occurring and they're out trying to raise a round, and maybe they're not killing it. And so when you think about the second largest expenditure of a company beyond payroll is paying back their debt obligation, that can turn off new investors. So that's generally what happens if you take on too much debt and you don't get these accelerated growth plans.
Yeah. Chris, how would you look at a company that has taken on some equity, then took on some debt, and now is, maybe got a little bit of a sideways or upside down structure? How does that affect your analysis of whether to come in the company if quite a bit of your capital is going to go out to recap the lenders?
It does sort of impact valuation because it's somewhat modest impact, honestly, because you're just thinking pre and post money, and more of the primary capital needs to go to pay off the debt or restructure the debt. And so that definitely has, I would say, a modestly dilutive impact. So I don't think it's, again, depending on the valuation profile of the company. But, we we like to use debt modestly upfront, as has been described, and then kind of more materially on the back end to skip a financing, in our view. And so, when a company's more like 12 million, 15 million and growing at a reasonable rate, you can use that debt to further accelerate growth and get to the right scale where you can consider, a partial or, full recap. And by skipping that financing, you not only skip incremental dilution, you create better alignment. Because, whenever you bring in a new investor, guess what? That investor has an opinion on when you exit and what kind of return they need. I don't get that opinion from Robert or Vic. They're up for exit whenever we want to. And so, syndicate alignment is a big deal and something we ought to talk more about. But, I think investors, like Charlie, Eric, and I do a lot more diligence on companies than they do on us. And entrepreneurs should diligence their investors as much as we diligence them, because the partner you pick is incredibly important, and that alignment and how you collaborate is important. And so having the option for debt to sort of keep a tighter alignment around the investor syndicate and reduce dilution and allow you to exit in a different time frame, I think is enormous opportunity. And so we often go down that route.
Right. I'm going to ask you a question, Eric. If you want to put up another poll question, that's great too. And we'll get it up and hopefully won't block out Chris's face too much. But Chris, you said something very interesting there, and we do have a lot of people, and the polls are indicating that we have a lot of earlier stage investors in, they're looking to raise 1 to 5 million, kind of Series A or Series Seed rounds, in the next 12 to 18 months, which is fantastic, and see that kind of entrepreneurial activity. But you say that prospective portfolio companies should diligence their investors. How do they go about that, right? They can get on Crunchbase, they can get on PitchBook, they can look on LinkedIn, but what's the real way to figure that out? Who should they be talking to, and how open are you about saying, we'll talk to this person, talk to this other person, so forth? And how do you give them the references that allow them to really analyze who you are to create that alignment?
Yeah, I mean, we obviously do reference checks, material reference checks on people we back. And so we offer for them to do the same on us. So, it's easy to highlight, oh, these companies work great. So talk to this really happy CEO, but, why don't you talk to some of the companies that, weren't performing as well, and see how those situations were handled, and, if we're the right partner. And so we encourage, entrepreneurs to do a similar level of diligence. And, we're very sensitive to syndicate partners too, because we've seen and lived through syndicate misalignment. So, where there's firms like S3 that we know well, that's easy to get comfortable with, so we do our own diligence. If there's, an early stage investor, we make sure we're aligned and we're thinking the same, because syndicate misalignment can cause you to miss opportunities.
Matt, I could jump in on that question too. I mean, I think, at least me personally, when I'm getting to the point where I'm giving, a term sheet to a founder, I'm sending over a long list of every CEO in the portfolio that I work with, and their cell phone number and email, and maybe a blurb with some background, and say, ask them about this, ask about that. Even if they don't ask for it, like the whole business kind of resides on your reputation in the venture world. And hey, this is the one that missed their plan by 50% last year. Talk to them about that and how we reacted and how we worked through that and things like that. And so, yeah, I would encourage all founders that are out there to do just as much diligence on the investors, and hopefully you're in a fortunate position where you got multiple term sheets, and so that should be a key part of your diligence. And to Chris's point, same on VCs with syndicate partners. I fielded a call last week on somebody we're co-invested with, and another local firm was going to co-invest with, and those kind of things. So yeah, all that stuff is very important.
Charlie, I'm going to ask you a question of sorry, go ahead, Vic. Let me let Vic go ahead.
I was going to say, we've all been in the market for a while, obviously. So we have a track record versus being in the market for a couple of years. So just poking around Texas, it's a small world. You can definitely get a sense of how we each operated with our companies. And during a time of COVID, there's no better time to see how your investors have really stepped up to help you in a situation nobody knows how to handle. So, everybody's happy when things are going great. It's when things are not going so great is when your investors really step up and put a helping hand in.
Yeah. Charlie, I want to ask you a question, and you and I've gone through some of this together at board meetings and so forth on some companies that a different type of investor alignment. I mean, I'm very comfortable and understand how S3 and elsewhere, I know what the alignment is with SVB, with Cypress, et cetera. But talk about when you're coming into a company, and a lot of the folks on the call with us today probably have some angel, friends and family financing. How does that affect any of your alignment in terms of investment objectives, willingness to see things through some hard times, or let's say a strategic shows up and waves their hand and, you guys want to put some more money in and swing for the fences, Chris and, and Charlie, and maybe some of the angels and friends and family are good with taking a 2X or something and, calling it a day. Does that resonate with you? I mean, I know we've dealt with some of those kind of misalignment issues before.
Yeah, there might be certain situations where people show up and want to buy the company, or maybe there's financing and maybe the investors may want to go long, maybe the founders can have a great outcome. They want to go ahead and exit. I mean, those things definitely arise. What I tell founders, and I think what they would do in reference checks with me and S3 is that, we're going to back what they want to do. If they want to exit now, it might not be the greatest outcome for the firm, but if it's going to be a great outcome for the founders, and this is kind of the direction they want to go. I mean, the last thing a VC wants to be doing is telling a founder to not sell, and then you have a disengaged founder that was like, I should have sold, and then trying to move the company forward. So that's a really tough position to put an investor in, even if it's not going to be this return the fund, huge needle mover on the fund economics, but is a good outcome for the founder. And you have to appreciate that that they've been at it for a long time and they want to get an exit. And so those scenarios definitely arise. More interesting ones are when you have kind of, hey, maybe we've been in it a long time. Then you've got a new investor that's come to the table and they've only been in it for a year or two, and they want to go longer and say, wait, maybe it's a exit we'd be willing to take. And I don't know, I haven't been in one where that's been really contentious, but it is something that I'm often coaching founders on about, hey, and a lot of it plays into valuations, right? So we had a scenario where we recently funded a company in the past year that, at a great valuation, and maybe they could have raised at a larger valuation and raised, 3x the money. Hey, we're going to go raise $60 million or something crazy. And I said, we could go do that. I said, but if you get that valuation, well, your exit expectations might get misaligned, because if somebody shows up in 2 years at XYZ valuation that maybe is really interesting to you, and that's going to be interesting to your early stage investors, this later stage larger firm that has $1.5 billion fund, to move the needle on them, that's not interesting to them at all. And in fact, they're going to have blocking rights on that. It's just something that founders have to contemplate when they're looking at taking on these larger rounds at these, the valuations are kind of crazy right now, higher than anybody on this call has ever seen at every stage, basically. And everybody's kind of moving up to adjust to that. But something you have to, keeping people on the cap table aligned at certain levels is something that the founders and management team should always be thinking about and be cognizant of and be talking to their investors about.
Yeah. And I'm going to ask Chris about secondary in just a minute, but before we got some time left here, before we go to Q&A, I want to each one of you give us kind of a good case study. You can scrub names if you want, protect the innocent, or you can mention some recent successes of some things that you really were proud of, you thought worked. But Chris, so I'll give you a chance to think about that while Chris answers this next question. So Chris, with what Charlie says, one thing that I've seen over the past 10 or so years is the development of a secondary liquidity mechanism where you're not cashing everybody out, but you're allowing some angels to blow off some steam and come off the cap table if they want, or the founders to take 6 figures or low 7 figures off the table to kind of gain some comfort and go to that next leg. Can you talk a little bit more about that and kind of how you look at that and those conversations that you engage in with founders on that regard?
Yeah, as Charlie was indicating, alignment with founders and the management team is incredibly important. And so we make sure we do that in the outset, and we just point to how there can be partial liquidity at major growth milestones. And so in our view of, major growth milestones kind of going from that 3 to 6 million to 20, and then bringing in a growth equity or private equity partner and offering partial liquidity. What that can do is improve patience to get to exit. So we've seen partial liquidity help folks be more patient, because if you have everything locked up in one deal, and this is where me and Robert's friends in Silicon Valley disagree, but I believe in partial liquidity along the way, and not, enough that they're comfortable, but not, overly liquid, if you will. And then what it can also do is clean up the cap table from, prior investors. And so if you have, friends and family angels that have been in it for 7 years, and you've only been in it for 3 years, you can give them material liquidity. So it can just sort of clean up the cap table, lengthen the timeline. And so I think that's the major benefit to private equity and growth equity is, we all live in this illiquid world, if you will. And that's the biggest challenge. And so, once you achieve various growth milestones, being able to access partial liquidity or full liquidity, depending on your situation, just sort of creates better alignment and better patience, and you can have better outcomes. So that's core to our approach. But as Charlie indicated, I think it's incredibly important to amplify this. Best price and best partner rarely ever line up. The firm that needs to overpay is rarely the best firm. Why would they overpay, right? And so, the biggest debate among entrepreneurs, best price and best partner, it's hard. It is hard, but again, as Charlie highlighted, you can calibrate the amount of primary capital to balance out the dilution to get the right partner. And that's really a key consideration.
Yeah, where I try to lead my clients when I can is, best partner as long as it's a reasonable price, right? Best in best. I mean, usually, unless you have a gulf of difference, tens of millions of dollars difference in the pre-money valuation, but where they're pretty close, you got to really focus on that partner because that, you're going to live with this person for, 7 years or so, maybe more. Robert, any thoughts on when you see founders get liquidity or some of these situations, how the banks look at it? And then I'll let you answer that. And I want to get you and Vic to talk to a couple of case studies, some recent things where you've really kind of been proud of your involvement with the company and how you've worked through some things. And Vic, I know you've got some really good. I'll let you pick ones you want and name any names if you want, but I've got some case studies here for you.
Sure, yeah, and one item to maybe disagree with Chris on is I'm a Texan, so my friends are here in Texas. Just want to clarify that.
You still talk to in the Valley.
So, yeah, gosh, we're in an interesting business because we're actually we derive a lot of our income from annuity type business. They borrow from us and they pay us back over a period of time and earn interest over that period. So when there's a liquidity event, while we might have some warrants and have a good outcome there, we also churn clients, and our business churns 20 to 30% of our client base annually, either through failure or exit. So it's just the nature of our business. But when they do have liquidity, it's great because we have private bank and we can work with them on the wealth advisory or help them finance a big home purchase or whatever it is. So yeah, and we're looking. The other thing that's fantastic is entrepreneurs churn, even though they can. Cycle. So even though that they may have an exit and they could go sit on a beach somewhere, most of them don't have that in their DNA. And so I don't have enough fingers and toes to count the number of entrepreneurs that I've worked with, or CFOs for that matter, that I've worked with multiple times. And we build a great trusting relationship with one another, and it's great to see them work with either as an angel investor or start up their next gig. Hey Matt, you're on mute.
I was going to kick it over to Vic. That was great, Robert. I appreciate that, and cheers to some native Texans, as am I. No offense to those of you who aren't. We love you all, but we're fewer and farther between these days, it seems. So, Vic, go ahead and
give a case study, right? An example. At a high level, 85% of the companies we invest in, that have exited were either through a growth equity with venture debt, PE recap, or strategic exit. So the companies we're investing in are picking one of those three paths following our investment. So, and to something Charlie said earlier, as an equity investor comes in following us, if an entrepreneur did whatever they could to avoid dilution, that tells you how much they believe in their equity, which is why growth equity funds pay close attention to the companies we're investing in, because that's what that's what they're investing in. To give you a good example, we have a Colorado-based business called Madwire. We were their first institutional investment. They raised a couple of million from us when they were doing about $6-7 million in revenue, and then in about 18 months scaled to about 17 million. And then at that point in time, they raised a growth equity round. Obviously better valuation, better terms, et cetera. And then we syndicated with another private equity fund at that time, and we provided 2 tranches. So in this case, we started with royalty, the company grew, they got to know us, we got to know them, and then they did a growth equity round of which we participated. And they never raised another dilutive round after that. So they're approaching 500 employees, 9 figures in revenue, and the majority of the company is still owned by the father and son, and scaling really nicely. So that, obviously that's a highly positive example, but that's an example of one of the many success stories for our entrepreneurs.
That's great. Chris, I know you've had some recent successes. Talk about some of the ones you're really proud of and have enjoyed, where your model really benefited the company.
I prefer to talk about, things that weren't successful, because I think those are, it's easy to talk about the wins, but, I think, I reflected as, I spent a lot of time as an expansion stage VC, and my strategic advice to my, executives and entrepreneurs was, very consistent and simple. Every time I talked to them, I'd just say, grow faster, get bigger, grow faster, get bigger. And sometimes I was right. And sometimes I reflected back and I'm like, how many companies did I screw up by just telling them every day to grow faster and get bigger, when maybe that wasn't the right approach? And how many would have been healthy outcomes with a more balanced growth approach? And so I had one of those moments that you always reflect upon, that kind of changed your thoughts and strategies. So I had a company in Austin that angel financed their way at about 3 million in ARR, put in $6 million of primary capital, and they never raised any more outside money, and went from 3 to 15 in about 3.5, 4 years. And we got offered 125 million from private equity. And of course I was the VC, and I said, that's terrible. That's not nearly big enough. And the founder and entrepreneur said, Chris, that's a life-changing outcome for my family. And you're going to make 4x in not even 4 years. And I don't think you're at risk of losing your money since you invested. And shouldn't we all be happy? And that was one of those moments where I'm like, I think he's right. I should be happy. And so we supported the outcome, and it kind of influenced the thinking of, we're not opposed, and have had, high growth companies where we lean in and help further fuel and accelerate that growth, and have had, some great outcomes. But, taking a balanced growth approach, actually understanding what the Rule of 40 is and explaining it, has helped us align with entrepreneurs in a wide range of outcomes. And, key learnings were not to take, a single approach to every company.
That's great. Charlie, I know you guys just had your recent, your first IPO out of your portfolio. I think it was, right?
Yes.
Congratulations on that. But I don't know if that's what you want to talk about, or some of the other, sometimes there are different things that are rewarding in your professional life or your funds. Of course, that was a great answer, Chris. But talk to us about some of the things that you've seen that S3's really brought some value.
I'll obviously plug Alchemy, first company IPO. We were the first institutional investor almost 10 years ago. It was one of the first investments I worked on at S3. And we led that. We called that a Series A. That would have been called a seed round these days. And then when large investors, their Series B, we partnered with our LP and co-led their Series C. Then we brought in General Atlantic for the D, and then we did E, and then pre-IPO round, and huge outcome, huge success in Texas as a whole, for another B2B SaaS company to get public. That's funded mostly by a Texas firm. And I think it's going to be huge for the Dallas ecosystem. I mean, lots of millionaires were minted in that IPO process, and it's just there was a lot of times in the early days we thought, can you build a company this big with this many technical people in Dallas? We have to open an Austin office or something like that, and we proved that was not the case. We have over 600 employees in that company, and virtually all of them are in the Dallas area. So obviously super excited about that one. That was a really fun one. To Chris, just talking about debt, I mentioned one earlier. We did have a company, this is years ago, that we worked with, and they couldn't raise equity at valuations they wanted, and they didn't want the dilution. So then they levered up the company with a bunch of debt from a traditional bank, and then it was interest only for a while. Let's call that 2 years. And then the company hit some technical issues, and it caused a large customer churn issue. So revenue was doop, 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 and then it came down like this right about the time that debt started amortizing. And it was, to Robert's point, the second biggest expense on the income statement besides payroll, and they basically couldn't afford to. And there was a scenario where we could have gotten the company to break even, probably kept it alive and maybe kept it going, but the debt was just too much for the company to handle with the churn issue. we hit what they call the zone of insolvency, where you basically you have to do everything you can to try to get the bank paid back, and that's what we did. And so equity investors lost all their money. We got the debt paid back. It wasn't SVB, it was another bank, but yeah, so you just hate to see that. And so that experience is one that makes me just super cautious with how much debt to take, when to take it, and all those kind of things.
Yeah, that's great. There's a question that came in, and Chris had answered it. Vishy Subramaniam, it's a great question. It's a little bit different than what we've been talking about here, but I think it's a great question, and we should talk about it because there are different ways you can approach it across this whole panel about it. If a company is incubated as startups, I take it a larger strategic company has built kind of a startup enterprise internally, and maybe it's non-core to its enterprise, and the founders want to take it off separately. How are you going to do that? Chris, I know you have, at least in the TL or AV stages, done some things like this before and taken some companies out, but do you want to talk about it a little bit more? And I'm curious to know how the other panelists would view this particular fact scenario. I've had a chance to do it a couple times, and I will tell you, there's no right or wrong answer. It's really tricky, and it's getting the larger company to actually really let go. They say they want to let go, but they won't. But that's part of the art, not the science. But talk a little bit about how we view a situation like this if you met a good entrepreneurial team that was trying to spin out of a larger company.
Yeah, if it can be a clean spin out and there's a team that's already kind of with it and they can cleanly divest it, then I think it can be a VC kind of opportunity. But I've also seen situations where there, it's just a technical team that may be attached to it and not kind of a full management team. And it turns into more of a divestiture where private equity or, growth equity kind of takes a majority position and then take the, I do know of some firms, one in San Francisco called Turn River. And basically what they did was go to companies like Rackspace and ask them to divest things. Like, what do you want to divest? And they would spin stuff out, buy it, and put it together as a company. So there are actually firms that focus on this kind of more private equity-ish, but I think to qualify as a VC kind of seed, Series A, whatever, and Charlie's better at judging this, but I think you need like a team and it really being divested and clean. And so, those can be tricky situations, but I've seen it kind of a little more in the private equity world because they can bolt it on to an existing portfolio or they can bring in a team to take it over.
Yeah.
And just, I just wanted to add, so I know Vishy, so he has a small business that's growing nicely, and now he's added a software component that's different than his core business. So he's looking for funding for that. So it's a little different of a scenario. But we've done deals like that where, the company's growing nicely, and now all of a sudden they add these other adjacent software platforms, which, they may spin out in the future, but the revenue of both entities, even though this one may be tiny, we can invest in that and leverage the revenue of both. Even though most of the capital may be going towards this new startup that's within the, within this $10-12 million business. So,
we've seen there's no one size fits all approach on these, and we've seen some even in the startup realm. Chris, I know you've done some where there was one company that spun off 3 different things, right? So we identified a non-core asset, dividended that asset out into a new co, and then that one did the same thing again, right? And that was a very interesting scenario that played out over many different years. It was the gift that kept on giving, and each one of those companies was successful in its own right with some entrepreneurs. But it can be difficult pulling it out of a company. Robert, have you guys looked at any of these situations where you're pulling it out of a larger company, and how would you look at that? Because they may have some ongoing cash flow and relationship, or at least a transition agreement with the parent company.
Yeah, well, depend if whether or not there's a sponsor involved. If there's a sponsor involved, that's a great use of venture debt, and we just have one right now that we're in the midst of closing. I think we're putting forth $15 million. The sponsors putting in the same amount of equity, and it's going to be cash burning businesses. So it's a great use for venture debt. If it's not going to be sponsor backed, it's much harder because then you're going to rely on quality of earnings and how comfortable can you get with the cash flow generation and financials that actually aren't generated on an ongoing basis for that specific business that's being spun out. So that's where you got to have a really high quality QOE, and even then it can be difficult.
QOE is quality of earnings, got a real test. Let's go to some of the other open questions. There's some really good ones here, and let's try to do some quick hitters and take them in the order that they were received. Jeremy Moore, are there any specific risks that prevent you from entertaining talks with SaaS B2C firms? Charlie, do you want to take that? How do you look at sort of B2C and so forth? Do you look at that?
Yeah, it's not been our focus. It's not where our expertise is. And frankly, as you're focused on Texas, there hasn't been a ton of big consumer things in Texas. There are definitely a few. We launched Investors in Favor. That's been our one kind of bigger consumer thing. We will look at it. We will look at what we call a digital experience, and maybe allocate some of our fund to that, but it's not a core focus. But it's not completely off the table, I guess. Open to it. Those consumer deals often take billions in capital to get really big, and sometimes that can misalign with the smaller fund focus as well, but not completely off the table.
Yeah, the scale's tough. Vic, I don't know if you're the right person to ask, or anybody that want to field the best approach for startups with traction to raise 1 million for growth. That sort of first million, I always tell people, is the toughest. Any advice you could give in here?
Yeah. When you're getting off the ground, obviously friends, family, angels, folks that know your industry are probably the best to start off, get some traction. And then, if you were looking for a $1, $2, $3 million dollar round from there, obviously we're a great option for you to bridge to the next round. But yeah, early on, it's going to have to be, seed or somebody like that, like Charlie. The companies we're investing in tend to get sort of, strategic angels, folks that have built and sold businesses in that particular industry. The learning curve obviously is much lower, and then they can provide a lot of insight and advice in addition to, the $100,000, $200,000, $300,000 they're putting it in. But yeah, you'd have to cobble it together to get to that million is what typically happens.
I'd second Dick's comment that anytime there's an industry veteran that maybe they knew previously or didn't, that's in the early money, that's typically a really good sign.
I'm going to skip down to the bottom. Derek Dorner's question. Derek, on taking the $300,000 from the SBA on a kind of long amortization note with a low rate, I don't see any issue with that at all. You just need to make sure that you can, it's a positive, not a negative. And whether we have the PPP loans that were out there, some of this Main Street lending, which was less popular, or what you've got there, the only thing I would say is that sometimes the SBA has certain restrictions on various things that the companies can or can't do and certain reporting, but it's really just a matter of dealing with the reporting you have to do into the SBA. But I think it's a very positive thing for the company, and treat it appropriately. And that's the kind of thing I would take as long as I could to pay back, right? And only when I had to. I'm going to get to Tom Sloss last. Steve Peterschmidt, anyone on the panel invest in bridge rounds for pre-revenue companies in a hot market. So Charlie, do you or Chris, what do you like to come into the pre-revenue? When do you look at some of those specific opportunities? I'm gonna assume Robert and Vic aren't quite ready to do that yet, but maybe talk about when you look at some of these pre-seed opportunities.
I forward all those emails to Charlie. So
we are getting earlier and earlier. We used to say kind of a few $100K in ARR kind of as a minimum. We are looking at companies and putting out term sheets on companies that are even sooner than that, just for a whole host of reasons. Really true pre-revenue in a SaaS business. We have not been doing that lately. We do some medical device investing in that case where they're going through some kind of regulatory approval we do, but that's a whole kind of different animal. But yeah, it's just not where we focus. But there are other groups that are kind of seed funds that just do seed stuff, and that's what they do a lot of. So just not where we're typically getting involved.
It's tough. It's friends and family a lot. I'm going to start answering Tom's question. I can go over a few minutes if others can. It may go because there's a couple good questions here that have just come in as well. So those of you can say I'm willing to stay and answer and work with the panelists to do so. Tom, on this discount for growth equity round, I assume you mean secondary sales of the common stock. Typical lawyer answer is, it depends. The direct answer is I've never seen a founder who liked to discount their common stock when they sell it in the future. The real answer for Chris and others are going to be, what does the preferred stack look like, and what am I getting for it, and what is the overall look and feel of the company? We're able to do things on the legal side that we can engineer it, whether it be adding an additional restrictive covenant like a non-compete. California companies who can't get non-competes, you can throw a non-compete onto a founder in connection with a sizable enough sale of some stock. We can do things like that. We can add releases, we can add so forth. There are certain situations in which, we've got to be very mindful of companies repurchasing shares because it could blow your qualified small business treatment, which allows founders to get 0% on capital gains if they hold their stuff. But there are situations. We just did a deal recently with another local venture firm here in Austin. The company bought the shares back below the thresholds that would have blown up 1202 and sold the investors the preferred stock. So there's a lot of ways to do this. And Tom, buy me a beer and I'll talk you through the whole thing. So Tom's a good friend. So Christopher Hugman, this is any of the investors right here. I mean, it's interesting. We saw the poll results. I don't know if we have those still available, but I think the majority of the poll was somewhere between companies operating business as usual or, even positively. Certainly there have been some that have had negative impacts. This growth rate right here is pretty interesting. I don't know, you guys, what would you say to Christopher on this question?
I can't see the question. I don't know if the others can.
If you look at, the question is, when considering an investment, do you account for the impact of the pandemic on company growth and performance? I mean, you don't give a discount for it. I mean, how are you addressing the pandemic in terms of how you're assessing companies? Would be a way I might rephrase it.
Yeah, I mean, I think investors are definitely taking that into account. We have a company in market right now where we led the A round, and they're raising kind of a small Texas Series B, if you will. And that's part of our pitch. Hey, it's doing this. It did this during COVID, and now we're back here. We're growing again, and it's just kind of the reality of the situation. Like I'm in healthcare, and it was hit really hard. But it's all getting taken into account. The reality of the situation is, if you thought you were going to be at 6 million in ARR, and because of the pandemic you're only at 3, you're still getting valued on that 3. I think it's I mean, maybe give the benefit of the doubt, in some kind of evaluations, and we're learning this in real time. I haven't had specific examples here of late where that's been a factor, but I think that's the reality of the situation. If you didn't grow as much, you're going to be kind of valued on where you are.
Yeah.
Given the number of clients we have, we saw across the board, and it really was sector specific. And for those companies and sectors that got impacted, the obvious one, travel. And it was a great opportunity to see how management would respond. And so how they responded, and then how they have started to build back. We put, in many circumstances, we put more chips in those situations because the management team was so responsive and communicative.
Do you want to talk, the last one here, Grayson Dawson, do you see a successful crowdfunding campaign as an alternative in early traction? We're trying to raise that initial $1 million. In other words, instead of friends and family actually going the true crowdfunding site, or some of these companies have sites and do that. Chris, Charlie, do you guys come into those type of companies? And Robert or Vic, do do those count as a syndicate in terms of how you would look to put money in?
I am not very experienced in the crowdfunding universe, at least the recent evolution. Something Matt could probably chime in on. I worry a little bit about structure. If you got and probably regulatory issues too, if you have 100 angels and how they qualify and how all things work. So it's having a smaller group of angel investors that you can reach out to when there's a follow-on financing and all those kind of things. The crowdfunding thing with N equals 50 or whatever on your cap table, I think, hey, at the end of the day, access capital is important and getting you down the road, but I think it comes with some complications when it's a larger, pool.
Charlie, any thoughts on that?
We haven't funded anything that's had any massive crowdfunding raising before we got involved. That's not by design. That's just, I think those tend to be more consumer CPG type companies than, traditional enterprise SaaS businesses. We've definitely funded some companies that have a lot of angels, 100 on the cap table or whatever. And to Chris's point, it's always ideal to have less, but that's not always the reality of early days of fundraising. So So I don't have a ton of experience with crowdfunding though.
One of the big differences of crowdfunding, and it's not something I've done a couple times, and we tend to shy away from it in this market, because you can dip down below the true accredited investor, and go get $5,000, $10,000 increments from people who aren't qualified. You can raise that money. They tend to work well for restaurants, some CPG things where you're trying to get off the ground. You can make a quick flip on the company and so forth. SaaS software companies, I don't think it's a good fit, because as you look down the road, you're looking at institutional people like all the people on the panel here today, and it gets really tough. Those people can't participate. They literally cannot participate in future rounds of financing. It can get tough, and it starts to put a lot of stress on the cap table. Things can look a little wonky when you try to go sell the company as well later. So it's a very difficult, but I would do everything I could to avoid it when I'm in the SaaS software space. There's every rule is made to be broken, but generally speaking, restaurants and a few CPG enterprises, but large scalable enterprises where you think you're going to bring in institutional capital, I would tend to stay away from it.
Agree.
Well, great. Well, thanks very much, and thanks guys for staying over a little bit with us. It was my pleasure to do this, and I'm glad we could reach a pretty broad audience. I want to do some of these in person, and I'm back in the office today. I see some of you are, and we're really looking forward to things opening up, and hope everybody has a wonderful summer and gets out of some of this Texas heat, or at least has a pool or a pond or something to go jump in the meantime. But I look forward to seeing everybody in person sometime soon.
Thanks for including me. Thanks, Charlie.
Thanks, everyone.
Everybody.